This is Daybreak Asia. We're counting down to Asia's major market opens. And Heidi, I think that sound, that sigh of relief is going to be pretty palpable across the session today. And Jay Powell really just indicating they are look to cut rates. Not quite just yet, but the path is pretty much the same one we thought we were on already.
Maybe not so palpable is any sense of relief when it comes to investors looking at China, right? We've seen policymakers across the board kind of heading back, defending that around 5% GDP target, saying that it is attainable and there is room to further cut RRR. The other thing, of course, we're watching is Japan, this kind of rapid positioning for liftoff from the BOJ. Those wage numbers were not too bad, Belle.
Yeah, certainly actually pretty much stronger than what had been expected, because we saw real cash earnings rather rising 2%, and that was a lot more than what the survey had been for a gain of 1.2%. But this is the start of trade here we've got with the broader index, or the Nikkei 225, that's back above that 40,000 mark. We had been fractionally below that over the course of the week. But certainly the stock moves that we're seeing here echoing that US session overnight, as we did have Jay Powell delivering the first of his testimony, but certainly indicating that the path for rate cuts is clear later this year, perhaps. So that is playing into the dynamics around that dollar weakness that we've seen, and the yen off that. We are just fractionally below that 149 mark. As you said, that is positioning as well that's coming into play around expectations for the BOJ to be exiting, and something that's going to really put pressure on them, perhaps, as you say, are those wages data that we got out, because we had labour cash earnings rising year on year more than the survey. Real cash earnings, they were still in contraction territory, but again, it's that picture that we're seeing of improving wages demand, and that's what they really want to see, sustained salary gains before shifting away from negative policy settings. That's Japan. Let's shift now and take a look at the outlook for Korea as we come online here. And again, it is that positivity, that tone of optimism you're seeing coming back into markets in this session so far. Again, that story of dollar weakness that's playing out a little bit. We did have the greenback sliding to around a 1-month low. That Korean won, once again, a little bit more positive here, even though you do see US futures trading water at this point in time, Heidi.
Yeah, take a look at how we're travelling when it comes to the direction of trade here in Australia. We are seeing a little bit of upside, about 0.25% higher there. Largely financials and industrial supporting the stronger side of that market in the first hour or so of trade. We are still seeing levels pretty close to record highs at this point, so kind of incremental gains being seen for the ASX 200 today. The Aussie dollar starting to gain a little bit more momentum, 65.68. As Belle mentioned, we saw the lows for the session when it comes to the greenback after what has been a few weeks of more or less range-bound trading. Still, we do see some views when it comes to potential downside risk for the Aussie. Disappointment from the Chinese economy is sort of at the top of that list. But in this session, we are seeing the Aussie being supported by some of those higher metals prices and crude prices as well. Some of those stocks that we're watching, though, in Australia trading ex-dividend today, including Rio Tinto, another index heavyweight, BHP is one to watch there as well. Also watching crude markets, we're seeing a little bit of softness there when it comes to New York crude, just under $80 a barrel there. We've really seen still prices really holding pretty close to the year's high, mostly on signs of strong US gasoline demand, rising fuel demand in the US, which of course remains the world's biggest consumer of gasoline. Stockpiles falling by 4.5 million barrels last week in the US. That was a 5th straight decline ahead of the peak US driving season. And of course, we're watching US Treasuries as well in light of what we've heard from Fed Chair Powell, and that gives something of an assurance to broader markets, right? Treasury yield really being seen at risk of more flattening as we see that reaction continuing to play out. We're not just hearing from Jay Powell, but also heard from Neil Kashkari, seeing 2 rate cuts in 2024, potentially just 1. But take a listen to what we heard in that congressional testimony.
We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
Let's bring in Vasu Menon, Managing Director of Investment Strategy at OCBC Bank. And Vasu, perhaps nothing really new coming out of Powell's testimony, but at the same time, based on that, plus the recent economic data that we've had as well, do you still stick with that call that the Fed is likely to cut interest rates from the midpoint of the year?
We think so. We think that if inflation continues to come down and if the Fed doesn't do anything, this inflation is going to translate to significantly higher real rates, which will hurt the U.S. economy. And I think the Fed knows that as well. The Fed is trying to engineer some kind of a soft landing. If it keeps rates too high, even though inflation is coming down, that's going to hurt the real economy, may even cause a hard landing. So we think that, the Fed is holding its guns right now, but I think it is in the last round of its fight against inflation, and probably by mid-year, if the inflation numbers show a clear trajectory towards the 2% handle, which is the Fed's target, then, I think the Fed will undertake the first rate cut, and the next one probably in September. Then they probably do nothing ahead of the presidential elections and do one last one in December. That's in our view, and that's exactly what the markets are expecting right now, having Fed rate cut expectations.
Yeah, it's been quite a big repricing we've seen, Vasu, when you think at the beginning of this year we had 7 cuts that were being priced in. But as you say, the market is very much meeting what the Fed is saying now with the number of cuts. Do you think that sets us up for a period of relative calm then in bond markets? And if so, how do you trade around that?
Well, I think we shouldn't just look at rate cuts this year. I think the message from the Fed, and if you look at its economic projections, summary of economic projections, it released in December of last year, and they'll do the next one in a couple of weeks' time for March. And you'll see that the Fed is forecasting further rate cuts in 2025 and 2026. So 2024 is a bit uncertain, but the next 2 years, it's quite clear the Fed is going to take its rates down. And if rates go down, we think that's going to be good news for bond markets. We're actually positive on developed market investment grade bonds, especially ones with a longer duration. But we also see opportunities in the high yield space because we think that, defaults in the high yield space will kind of stabilize, especially given what's happening to the economy right now. So we see opportunities in the bond markets, but we also see opportunities in the equity markets as well.
Do you see opportunities in China? I know that broadly you're neutral on the market. Has any of the developments out of the MPC changed that?
Well, it hasn't changed, the dial significantly. We are keeping China on positive watch, and we're doing that because the Chinese stock market valuations are extremely low right now, very, very low. Expectations are very low. Foreign shareholdings in China also very low. So quite a bit of negativity has been priced into the markets. And we think that, if there's more good news that would come out in the coming months, the NPC was not sufficiently positive to, cause the markets to rally. It wasn't a strong enough catalyst. But I think the signal from the NPC is that, the Chinese government will do more, because if they're holding on to that 5% growth target, it means that to achieve it, you'll see more stimulus from the Chinese government, and hopefully that will change sentiment.
I suppose what would be the catalyst when it comes to becoming more constructive on China? But in the meantime, do you continue to see outflows being redirected to markets like Japan and India that have been kind of catching some of the interest diverted away from China?
Without a doubt. I mean, the two markets you mentioned are the ones that are seeing the benefits of outflows from China. So the Japanese stock market has done extremely well, and so has India. And I think that, in time to come, the other Asian markets could also play catch up. They've not done as well, but they could play catch up, especially once the Fed starts cutting rates. Investors turn more risk on, and if risk appetite improves, it generally tends to benefit Asian markets, Southeast Asian markets, and so there's more room for upside in some of these markets.
Let's talk a little bit more about Japan, because we've seen some of these refirming of yen bets, right? 1 month high for the yen at the moment when it comes to bullish yen bets over the next month, near the highest of the year on this chart that we're going to bring up next. I do wonder, does the Bank of Japan imminent liftoff, the implication on strengthening in the yen, does that change your outlook for how much further this rally has to run for Japan?
We don't think that, a much stronger yen is going to hurt the Japanese stock market negatively. It may, create some nervousness and volatility in the markets. But the reason why the Japanese stock market is doing well is it goes beyond just the yen. I think you've seen significant corporate reforms take place in Japan. Japan is on, in a new chapter in its economic history. And I think, some of these changes will continue for the next 3 to 5 years, and it will spur interest in Japanese stock markets. The Japanese stock market is relatively under-owned. It's only come to the forefront in the last, 4 or 5 months. And so there's a lot more upside for the market, we think, but it will not be a straight line. The yen may strengthen, but we've seen periods in the Japanese stock market where a stronger yen has coexisted with a stronger stock market as well. So it is not a game changer, if the yen strengthens.
And Vasu, one of the really big moves that we were tracking on Wall Street overnight was around New York Community Bancorp. Huge plunge. We saw it recovering pretty substantially, even to move higher off the back of that liquidity injection. But what are your concerns around US regional banks and tangent to that as well, any sort of concerns that you have around commercial real estate in the US?
Without a doubt, it's something that we are keeping a very close eye on. The commercial real estate market in the US is showing signs of weakness. But the regional banks in the US are the ones that are most exposed to this segment of the US property market. And so it's important to keep an eye on the regional banks. I mean, NYCB may not be the only one that will run into problems. But the good news is that we've seen a white knight, we've seen injection into the bank, and that resulted in the bank share price actually posting a gain of 7.5% on closing on Wall Street after falling by 47%. So I think as long as you've got support, capital infusion, and the Federal Reserve is prepared to stand behind some of these regional banks, we don't see the regional banks as a big risk going forward.
All right, and Vasu, of course, we're approaching that anniversary somewhat of the regional banking crisis starting last year. But thanks so much for your time this morning. That was Vasu Menon there, Managing Director at OCBC Bank. And let's take a quick look at some of the movers we've got this morning, because we're roughly 10 minutes into the session so far for Japan and Korea. But shares of Asian energy producers like Inpex, for instance, we're watching Santos, that's down in Australia, but some of these names in focus, given we saw oil climbing to near its highs for the year, it's after we actually had a US report out on rising fuel demand, and that certainly played into the dynamics because we saw WTI nearing that $80 barrel, a mark that it had retreated from early this week, and you've got it there just trading around $79 a barrel. Let's change on, because we are seeing those shares trade in positive territory, but taking a look what we're seeing for the footwear names as well as sportswear firms, we did actually see a big drop for Foot Locker on Wall Street overnight. Actually, it was down nearly 30%. So we did see a pretty bad forecast, or weaker than expected forecast coming out, and so as well a pushback on its growth plan. That played into the numbers. Today, yes, a bit of reaction coming through so far in ASICs, but Heidi, it really does seem like that theme of the session is that tone of positivity coming across equities.
Yeah, and of course, whether or not that flows through to China will be another question, right? We're going to get some analysis, Beau, coming up next with Hang Seng Bank China on why they see a challenging path ahead for Beijing to reach that around 5% growth target, despite policymakers now coming out and defending that target, saying that it is attainable. First, we'll be taking a look at geopolitics as well. The US said to be facing some resistance from allies, even as it urges an even tighter squeeze on Chinese chip technology. We have more on that exclusive next. This is Bloomberg.
Last year, we cut the required reserve ratio, or RRR, twice by 25 basic points each. Last month, it was cut by another 50 basic points. That means we released about 1 trillion yuan in long-term liquidity at a time. At present, the statutory reserve ratio is 7% on average, and there is still room for future cuts.
PBS Governor Pan Gongsheng there, who sees a possibility of more RRR cuts for Chinese banks. And he, along with China's finance and commerce chiefs, have defended Beijing's plan to grow the economy by around 5% this year. Our Greater China senior executive John Liu joins us now from the capital. So the defence of this target, of course, myriad concerns about how they attain this without forceful stimulus measures. Is this going to ring true with investors?
Well, I think investors are probably looking for more detail even yet. There was a lot of skepticism when Premier Li Qiang announced this 5% target earlier this week. This press conference, fairly unprecedented when you have the central bank governor, the finance minister, the commerce minister, the head of the securities regulator, the head of the National Planning Agency, all sitting together talking about the economy. We have not seen that in over a decade. Such a group of top officials. They were out to try and convince, I think, markets and the world of finance that there is going to be enough fiscal and monetary firepower there to make sure that China gets to that 5% target.
John, we've had a really interesting story coming out at the top of this hour around China's property downturn. Perhaps it could have some silver linings here because some economists are arguing that falling home prices could allow families to save less and spend more. But a lack of confidence of growth, of course, can be something that holds back spending. But still, are we starting to see any sort of positive notes come out of the weakness in the property sector?
Well, I think that is an interesting argument. I think ultimately, if home prices are cheaper, if people have to spend less of their disposable income on rents or mortgages, that does augur well for consumption. The issue is, how do we get from a period of relatively high home prices, where we were for the last decade or so, to a period of relatively low home prices without people really, the effect of falling asset prices and what that means for consumption habits and spending. I think that's the real question that China is trying to grapple with at the moment. We have seen some positive signs coming out of the economy. The commerce minister yesterday mentioning that exports for the first 2 months of this year increased by 10% from a year earlier. We had seen exports being a relative drag on growth previously. That seems to be a good sign. There are some signs of warming in the property market. In Hong Kong, we've seen a big uptick after the budget that was announced this week. A lot of hope on the mainland that will bleed over as well.
John, we've got a story up next about how the US is urging its allies to put the squeeze even further on China when it comes to chip technology. And I do wonder, are they focused more on putting out these domestic fires with the challenging macro environment at home, or is there also this renewed focus on the geopolitical, competitive rivalry, given the defence spending, given the R&D spending that we've seen be announced?
So I think the tensions that China has had with the United States is part and parcel, or is at least one part of the reason why the economy has struggled. We've seen a big decline in FDI from abroad. We've seen companies trying to look for alternatives when it comes to supply chains. The limitations on Chinese access to chip technology and other technologies, that is having a hit on a lot of Chinese sectors, be it from computing to electric cars. And so I think when it comes to foreign policy, and we'll hear from the foreign minister in the next hour or so, there is a lot of emphasis in Chinese diplomacy on repairing relationships, strengthening relationships so that they can help the economy at home.
That was our Greater China Senior Executive Editor, John Liu there. And as Haidi was alluding to, the US is said to be pressing allies to further tighten restrictions on China's access to semiconductor technology. But sources tell Bloomberg that the effort is drawing resistance in Japan and the Netherlands. So for more, let's bring in our Executive Editor for Asia Technology, Peter Elstrom, to discuss this scoop that we had at Bloomberg. And yeah, Peter, we've seen Tokyo and The Hague responding pretty coolly to this latest push.
Yeah, that's right, Annabelle. So the U.S. has been trying for a couple of years to cut China off from some of the key semiconductor technology that they would need for industries that the U.S. thinks could be risky or damaging, including military applications and AI in certain cases. So what we've learned from sources is that the U.S. is again going to its allies, in this case, the Netherlands, Germany, South Korea, and Japan, and asking them to tighten even further what they are selling into China, specifically to the semiconductor sector. And you're exactly right. There has been some pushback about whether the allies are going to go along with this. The U.S. imposed its first controls in 2022. It finally got allies on board, including the Netherlands and Japan, which are sort of key players in the chip equipment space. This year, and the Netherlands and Japan in particular are saying that they want to give these new controls more time to take effect before they decide whether there's going to be additional tightening. This would affect some of the most valuable companies in the world, including ASML Holding, which makes the chip-making equipment out of the Netherlands that's really the most advanced in the world.
Peter, how does this narrative potentially change after the November election?
Yeah, that's a very important question. Of course, this effort is coming just as we're months away from the election, just after we really have seen a decision about which candidates are going to be put forward for both the Democratic and the Republican Party with Joe Biden and Donald Trump. Both parties have one of the very few things that both parties can agree on is that they want to be tougher on China. So I think these steps about restricting China's ability to get access to semiconductor technology is something that's supported by both parties, but it's supported in different ways and to different degrees. Also, the cooperation with the allies is something that varies between the two parties. So the Biden administration has been reaching out to its allies to try to get support on these different fronts. The tension, as you can imagine, is that if the United States goes to the Netherlands and says we want ASML to do less business in China, that hurts one of the Netherlands' most valuable companies. And there's been pushback from ASML in particular saying that they think it could be counterproductive to stop selling, say, chip-making equipment into China because it's going to force the Chinese to accelerate their efforts to develop their own industry. So it will be kind of, there'll be a backlash within China as the Chinese companies invest more and more into their efforts to develop a domestic semiconductor industry. And we've seen some real progress on that front. Huawei Technology, the big telecom giant, came out with a smartphone last year that had a domestically made chip that was quite advanced, much more advanced than the U.S. was planning on allowing them to get from abroad. And that was a sign that China is making pretty substantial progress in developing the domestic chip industry.
Peter Elstrom there, our Executive Editor for Asia Technology. Much more to come here in Daybreak Asia. This is Bloomberg.
All right, taking a look at one of the currencies we're watching this morning, and that is most certainly the Japanese yen here, because we've had it strengthening beyond 149 to the greenback for the first time since February 12. A couple of different dynamics playing into that. You've got that dollar weakness, but you've also got yen strength, and that's really this speculation that's continuing to grow that the BOJ is nearing an exit from negative policy settings. We had wage gains beating the consensus earlier, that fastest pace since June. One of the things that they're going to be watching quite closely, Heidi.
Yeah, taking a look at how futures in Europe are opening, we are seeing Stoxx 50 futures looking a little bit softer. European stocks did close at a new record highs. A bit of caution creeping through ahead of what we heard from Fed Chair Powell, but potentially we see futures maybe trending a little bit higher throughout the course of the session. German DAX futures also looking pretty flat at the moment. We had quite a bit of leadership from tech stocks, media, auto sectors, the biggest laggards there. You can get more on TLI Vigo for all that analysis. This is Bloomberg. Right, right, we are getting breaking numbers out of Australia at the moment when it comes to the trade balance, and of course quite a lot of uncertainty as to how we see Australian assets trading, particularly in light of that exposure to China. We are seeing, when it comes to that trade surplus, coming in at just over $11 billion Aussie. That is slightly short of expectations. We're seeing exports rising 1.6% on a month-on-month basis. We're also seeing imports rising 1.3% on a month-on-month basis there as well. Also getting some of those other numbers through when it comes to investor loan values, home loan values, seeing some declines there, really reflecting the slowdown that we see across the property sector and construction. But when it comes to the trade numbers, we are seeing really a bit of a decline when it comes to imports, really pulling back from that almost 5% that we saw in December. Exports also a little bit of a fall from 1.8%. We're coming in at 1.6%. But of course, Belle, largely sort of the export picture has been well supported for Australia, particularly when it comes to key exports like iron ore and other metals.
Yeah, and interesting we get those exports numbers as well on the day we get China trade that's due later, and we had seen that strength already being signalled by Chinese officials that they had a bit of a rebound in the first couple of months of the year. But this is the outlook that we're seeing for the Japanese yen here, because it's certainly something else we're tracking very closely so far. It is, as we see the Japanese yen heading beyond that 149 mark for the first time since February 12, and it is that general return that we're seeing of BOJ trade. So yes, it's playing into the yen. This chart here, though, taking a look at dollar-yen 1 month risk reversal rates. And what's that signalling to us is that it's bullish bets over the next month for the Japanese yen are around their highest level of the year. So it is that positioning that we're seeing for the BOJ to pivot away from its negative rates, also playing out in JGB yields. They've been high. You've seen banks as well outperforming the benchmark. So that's the Japanese yen. As well, we had that wages data, that strengthening in the prior reading, certainly beating economist surveys. Let's take a look at the broader markets here, though, because we've got the Nikkei, we've got the Kospi half an hour into trade here, and it is that picture of positivity. Tracking the US session because it was a bit of a relief rally coming through, given we had Jay Powell pretty much reiterating what we've already heard from him in the past. Yes, they're open to cutting rates later this year. They're not open to doing it just yet. But the US economy is still looking fairly strong. Heidi, so that's the state of play for equities at this point. The question, of course, is China going to be joining that optimism later?
Yeah, and look, we've had a fair effort from China's top economic officials at defending the plan to grow the economy by around 5% this year. The PBOC governor hinting at a potential liquidity boost through the possibility, I should say, of more RRR cuts for banks. Let's bring our next guest, though, who says that target will be hard to hit without some large-scale projects. With us now is Dan Wang, who's a chief economist at Hang Seng Bank, China. And Dan, great to have you with us. And, the skepticism, you're not alone in sharing that view, right? How concerned are you about the ability to meet this growth target through sustainable organic growth and not, as you potentially allude to, these large-scale infrastructure projects that are really part of the old playbook?
Well, the domestic sentiment remain quite dire about economic outlook. The investors and consumers are quite fragile in terms of investing and consumption confidence. And when we look at the actual plan from the two sessions, there's a lacking of details. But we can actually see that the government intend to make more of the large-scale projects in the coming years. And for domestic consumer market, they used to be the main driver for China's growth before COVID. And now that momentum seems to be quite muted, since we don't have that reopening effect from COVID anymore. So this year's 5% is very different from last year's 5%. We no longer have the low base effect.
So does that mean the priority should be on building confidence within households and consumers? How do you do that without a quick fix to the property market? Do you see things like direct payments to try and stoke, consumer appetite being an option?
This is very difficult. The main drag for China's economic recovery remains to be housing. And the housing market, as we can see it, the liquidity is quickly drying up. Even the best performing property companies that didn't have a problem around 2021 start to show some weakness. So for the government, their number one priority is still to stabilize the housing market price. And that has postponed the decision for many potential home buyers because they don't see the end of this price decline. So I would say it's very difficult to restore the market confidence. But the government is making some clear signals from the report of the two sessions. We do know exactly where the money is going. It's still going towards the green industries, the low carbon, the high tech industries. So for investors, at least there's some positive signal on where the policy support will be.
Can you elaborate a little bit more on those positive signals, or is there anything else that came out of the MPC that made you optimistic?
Well, for the overall economy, at least we can see that there is more fiscal support from the central government. There's the ultra long-term government bond that will target more of the long-term infrastructure spending. And then for the local governments, it seems that their debt burden remain high, but part of that debt will be shifted also towards the central government. And for the emerging industries, they have unconditional support from not only the government, but also banks and capital market. And that is a positive sign to bolster some of the growth in China's manufacturing industry. But beyond that, I would have to say, to restore consumer confidence is a long-term plan. We can't just tell people to cheer up. The government has to do more, in fact, to make sure that people have higher income in the future.
We've been hearing from a range of different economic officials around this event, of course, and some of those have already sort of front-run the economic data we've got due later, the Chinese trade numbers, saying that we have seen expansion in the first couple of months of the year. Front-running economic releases, we've seen that a couple of times recently. What does that signal to you?
The trade data, I have no doubt, it probably will improve, at least in the import front. Many of the projects have started, and domestic market in spring looks better than in the winter. So there is reason to be more optimistic for domestic producers. But simultaneously, we have to see this bigger trend. Investing in domestic market is a risky business now, at least in the next year or two. And given how demanding the foreign buyers are to require domestic producers to relocate at least some of the production lines overseas, we will see actually more of an incentive for Chinese companies to go global rather than investing more at home. And in the MPC, there were also talks about supporting the Chinese government to go abroad and find a new market. And there's also talks about making a high-quality trade pattern. So all those together, we can see that at least for the high-quality growth model, as what they call it, China is still making the transition, and we're at the start of this transition.
At the same time, the demographic challenges are building, right? I like that you said before, you can't just tell people to cheer up and, spend more, right? Particularly when the longer term issues are really being consolidated. Were you disappointed that there wasn't more being said about efforts to address the demographic shift? We didn't hear much about hukou reform or any other kind of, domestic immigration related reforms.
The hukou reform, actually, it is still going on. I believe there will be more talks in the coming days. But beyond, if you're not trying to buy a home in Chinese biggest cities, actually the restrictions are basically gone related with the hukou. People have the freedom to move to any of the second, third-tier cities and counties. That's not a problem. And the main problems, though, is that before, Chinese government has been stressing more of a balanced growth model for different regions in China. But now, given that those remote areas, central western China especially, lacked momentum to find new growth engines, so more resources in the future will be actually moved to the most developed area like the Greater Bay Area, the Yangtze River Delta, where the manufacturing is quite advanced and high quality services are dominant. So that means we will see more of a capital and population inflow to those regions. But for the less developed regions, they'll keep losing population, keep losing money.
All right, that was Dan Wong there, chief economist at Hang Seng China. And coming up, we'll look at a Chinese e-commerce giant that's really been targeting cost-conscious Chinese consumers. JD.com approving a $3 billion stock repurchase as well after its fourth quarter revenue beat estimates. We'll have more on their outlook ahead. This is Bloomberg.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. When we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Fed Chair Jerome Powell there during his testimony before a House panel. Take a look at what we're tracking when it comes to a little bit more movement across the FX front. We have been so range-bound given the limited trading that we've seen in the US dollar, but some moves, particularly really being driven by Fed Chair Jay Powell's testimony, but also, of course, these BOJ expectations giving a lift to the yen, just being lifted to about that 1 month high there, and some of those bullish bets when it comes to yen expectations over the next month really starting to strengthen there. 149, so just over 149 where we're seeing for the for dollar yen trade at the moment. We're also watching the Aussie dollar, seeing a little bit more momentum, 65.70. That's being well supported by some higher metals prices. Also, higher crude prices sitting pretty close to the highs of this year so far on that sort of shrinking stockpile situation from US demand ahead of that peak US driving season. Some of the risks, though, potentially hitting the Aussie are yet to be really seen in that trade yet, potentially coming from the economic slowdown situation in China and how policy may fail to support that. Kiwi dollar trading pretty flat at this point, though.
Yeah, and Heidi, one of the names we're going to be tracking very closely in Chinese equities today and for broader Chinese tech stocks is JD.com, because they've approved a $3 billion stock buyback program after a reported fourth quarter revenue that beat estimates. Its ADR surged as much as 18% on the news. For more, let's bring in Bloomberg Intelligence senior analyst Catherine Lim. And Catherine, we know that JD's.com is a company that's really had a call right from the very top to fix some fairly deep-seated issues within the company. So where are we on that path, and what stood out to you from these numbers?
Right. You know, it is the worst performing e-commerce company from China this year. And I think what came through overnight from the results really was a relief that, you know, the company is not going to be burning all of its cash, you know, as it faced the competition from Alibaba, PDD. We're seeing the reiteration of a new $3 billion share buyback, an extension from the previous share buyback program, which was a relief, and more importantly, the 22% dividend hike. So the company is redistributing some of its cash even as it faced, you know, heads-on competition from rivals, including Douyin as well.
Catherine, what does this kind of tell us about the broad strength of the household, the consumer, right, in China, which has been one of the primary sources of concern in them being able to meet that broader 5% target this year?
Right. I think, you know, some of the indications coming through from the company overnight really is that, you know, they are still going with some of the low price strategy out there that clearly, you know, is a more discerning spending among the consumers in China. So we're going to see the low price competition still coming through from the likes of JD.com, PDD, as well as Alibaba. And I think, with that, we're going to go with the volumes gains coming from on the ground. And hopefully the companies will be in a position to actually drive some of these consumption, with affordable products as well as campaigns, which I think will be part of what the government is trying to actually support over the course of the next 9 months.
Bloomberg Intelligence Senior Analyst Catherine Lim there. Some of the other corporate stories that we're following this hour, and shares of New York Community Bancorp closed higher after Bloomberg revealed that the struggling lender is getting an equity investment of over $1 billion. NYCB confirmed the injection was led by Liberty Strategic Capital, that's a company of the former U.S. Treasury Secretary Steven Mnuchin. He'll join the company's board along with the former comptroller of the currency, Joseph Otting, who's been named the new CEO. U.S. crash investigators have accused Boeing of failing to cooperate in an inquiry into a mid-air blowout aboard a 737 MAX jet. The NTSB chair told a Senate committee hearing that it's, quote, absurd that Boeing has not provided all the information sought by investigators. Boeing hit back at the highly unusual rebuke, saying it's doing everything it can to assist the inquiry into the Alaska Airlines incident. Bloomberg has learned that Paramount Global is in talks to sell its stake in an Indian media joint venture to Mukesh Ambani's Reliance Industries. Sources say talks over Paramount's minority stake in Viacom 18 Media are ongoing and may not result in a deal. Bloomberg Intelligence estimates that a sale could raise as much as $550 million.
Well, popular weight loss and diabetes drugs are getting caught up in a bid by US lawmakers to reduce the country's reliance on Chinese biotech companies. For more, let's bring in Bloomberg's Sang-Mi Cha. And Sang-Mi, we know that there is a Biosecurity Act that's currently under discussion in US Congress. There was a Senate meeting overnight on that. What was the result of that meeting? And also, what is the significance of this bill to Chinese biotech and the industry there?
There were a lot of positive scenarios to this Senate meeting overnight. And I mean, in the past, many were saying that there will be a lot of the scenarios, perhaps entirely scrapping the bill, or there were many of these scenarios laid out. But it did advance to the next step, which means it's not already passed yet. It does have to go and pass through the Senate and the House, and then it needs to have the signature from President Biden to made into a law. But it does mean that it is closer to that step. And this bill is, the significance of the bill means that it would be blocking some of the Chinese biotechnology companies to do business or basically contract with the U.S. federal government. But the extent of this contract can vary, and so it could actually spill over to some of the private companies too. That's where the worry is here. And we're seeing already some of that impact in the share price when we look at Oversea-Chinese. That is the main company that is of the concern, which is listed in the bill itself. And so we have seen that its share price fall 40% year to date. And we are seeing and watching some of the more share moves when the market opens in Hong Kong.
Tell us more about the company that's in the crosshairs, Oversea-Chinese. How does it fit within the global pharma world?
Well, Oversea-Chinese is based in China, and obviously it does extensive R&D, so contract manufacturing for a lot of the pharmaceuticals around the world. So it's said that it does business with at least 20 of the largest companies, pharmaceuticals, the names that we already know around the world. And we found out that it produces most of the Eli Lilly's popular weight loss drugs, including Mounjaro. So that would mean actually that it is already, the supply chain is already pretty tight, and so that shortage would be intensified if the bill does go through, and that would actually the U.S. crackdown on the Chinese biotech could potentially mean supply chain disruptions to the global pharmaceuticals, and especially the weight loss drugs and the oncology drugs, so the advanced cancer treatment drugs, so to say. So we are watching again some of the three Hong Kong listed listed Oversea-related companies, Oversea-Aptech, Oversea-Biologics, and Oversea-XDC. Oversea-Biologics ADR has tumbled 12% overnight, so we'll be watching some of the impact on the Chinese biotech companies when the market opens.
Sang-Mi Cha there with us. More ahead on Daybreak Asia. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment snapped to 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rates.
World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Well, as we've been discussing, China's economic and financial officials have been defending their 5% growth target, while regulators promise to crack down on any market manipulation. Let's get a preview of the market opens in the mainland and Hong Kong with our Asia Stocks reporter Ishika Mukherjee. So we've seen the NDRC, we've seen the PBOC really come out and try and reassure, but also on a defensive note to say that this around 5% is attainable. Are investors likely to be convinced?
Heidi, they're taking on a defensive mode for a reason. I think investors are still very much looking out for big fiscal moves from the government, from authorities. Morgan Stanley just released a note overnight talking about how, everything that the CSRC, that the PBOC said at the presser was good. Positive messaging, that's great, but a big fiscal package is really needed to get China out of its current deflationary sort of cycle that it's in. And even as we look ahead to the trade data that's coming out later today, not a lot of expectations for exports to really help growth there. So China really needs to up its game in terms of, bringing out that fiscal bazooka that investors are all hoping for, but of course very cautious that that's not going to come because of all the narrative in China right now.
Yeah, and something else that's been really helping to prop up sentiment has been the national team. But now we're hearing from Jefferies, for instance, saying that they could start to slow their stock purchases. So how's that also likely to play out in sentiment?
Yeah, so Jefferies saw that 3,000 for the Shanghai Composite is the level at which sort of the national team steps back on purchases. They were tracking data for this year, and they saw that around Jan 16th, when we had all the quant fund selling, the big drawdown in small caps, that's when the national team sort of came in to support the large caps at that point, the market. And then they stepped back, and then they came back in on Feb 23rd. When they needed to prop up the markets again. So Jefferies thinks that now that the Shanghai Composite is above the 3,000 level, the national team is going to sort of slow down on purchases. Of course, the other thing we have to look at is short sales. Bloomberg Intelligence released a report saying that, while the government has been sort of clamping down on short selling, total short interest is at 43 billion yuan, and that's considerably higher than the 10 billion yuan that was there before 2020. So there's still a ways to go in terms of reducing the short sell pressure on the market right now. The CSI 300 is doing quite well from its recent trough. But yeah, that's what investors are watching right now.
All right, Ishika. That was our Asia Stocks reporter, Ishika Mukherjee, there joining us as we look ahead to the open of trade in China.